Welcome to the daily update, where I'll go over the action in the market from Monday, August 7th, and then we'll see how things are looking for Tuesday, August 8th. You're probably going to notice right away that I sound different, and the screen may even look a little bit different. I've been having some trouble with the computer that I use to do the videos. I had to switch to my backup computer, and I'm recording this using Zoom. This is all going to be take one. So you're going to get my flubs and stumbles and pauses and all kinds of mistakes that I make. But to get the video posted as soon as possible, it's pretty much what I had to do. As far as what happened on Monday, we're still holding above support. We're negative when we look at all of our charts, but we're not really breaking to the downside and we're not switching back to the upside yet. So we'll just look at things and see where we come out as of right now. Before I get started, I did the little thumbnail thing over the weekend and the results are in. You'll never guess this. Nobody cares. Yes, that's pretty much my attitude as well. I really didn't have any response to that. I think one or two people might have clicked on a like button. My personal opinion is I think a lot of these folks get over excited about what works and what doesn't work. I don't really care about those things. I want to just concentrate on what I teach and present it in the best way that I know how. As almost 40 years of an educator, that's what I've done. Okay. I may not have the massive number of subscribers. I may not get the massive number of views. I don't care about that. I want to help people that somehow find what I'm doing and then see some value in that and then can go forward. So and I've been rebellious for most of my professional life. Just for example, I went to a PowerPoint class one time because I used to lecture and do Microsoft certified courseware as an instructor. I'm a Microsoft certified trainer. And they said, this is how you're supposed to do PowerPoint. And at the end of that class, I said, okay, now I know what I'm not going to do. I'm just going to switch everything around my way and do it that way. And most of the time, that's been very successful for me. And that's the approach that I kind of take. If somebody says, here are the steps to do it the right way, I'm looking at doing it the opposite way and then adapting it to my own style. Okay. And that's about as much as I become rebellious in my life. Also, and I'm trying to advance the slide here. Also, yes, I'm having some trouble with the computer that I usually use to do the videos. So I'm having to use a headset on Zoom. So the quality, I don't know, some of you might even think it's better, but it's going to be different than what you're used to. Also, I'm thinking about this. This is just an idea at this point. If I was to prepare some kind of an online class and it was free and possibly do it in September, is that of interest to you? It There's no obligation. It's just something that I'm thinking about doing. Just to let you know, I do have a course that's on YouTube right now. That's a basic course. I also have an extended course that's not for free that I do on technical analysis. I do another course on different strategies that you can implement. And then I do another course on what I call mental analysis, getting over your emotions and trying to let more objective things happen as you are in the market. I might cover one of the areas 2, 3, and 4, technical analysis or strategies or mental analysis, just really lightly in this course. It might be maybe an hour long. I would probably do it on Zoom where you would see me and then I would record that, or I could do it on Facebook Messenger where I could also record that and then make it available if you're not able to attend while it's actually happening. Just let me know. Send me an email, make a comment, and see, yeah, I think this is something I could really enjoy and get something out of. And if I don't hear from very many people, well, I'll just wait a few months and then ask again. So that's kind of where I'm at right now. All right, let's go back and talk about what happened. And I know there's a lot of extra stuff in this video. Right at the open, we gapped higher at the open. We went above the daily pivot, which is kind of strange. When we get to the chart, I'll show you the daily pivot was quite a ways up from Friday's close. That's at that 44.98 level, which you could say is 4,500. That's kind of an important mental level for the market overall. And then we ended up setting that as support for the day. As the day went on, prices just rose from the daily pivot, and we closed just under R1 at 45.21. We were up 0.98%, but volume is below average. We're stuck in the middle of summer here, and a lot of people are gone. The market is at that point where it could continue to go higher. It could also break lower. The word on the street is that we're probably going to see a decline. We're also in a seasonally weak time. And so you have people that aren't really all that gung-ho to put new money out there on the line. The technicals were still negative. Now, in the short term, we've worked off a lot of that oversold condition. We're still negative more in the intermediate term. There are different pockets of strength, and I'll go through and show those to you, but it has to do with inflation and interest rates, and that's been the story for the last year and a half. Some comments that we can make: we were able to regain 4,500 on the S&P 500, but value outperformed growth. After the market opened and we were going up kind of strong, growth was almost unchanged. Well, value was up pretty strong, and that just let me know that there's not a lot of strength behind this move, even though we ended up finishing higher. Near the end of the day, it was probably some short covering because you have a lot of folks that are shorting the market right now. And when that went against them, they had to buy to get out, and that ended up pushing prices higher. On an intermediate term basis, we have the bullish percent index for the S&P 500. That's still extreme, but it is declining. On the positive side, you could say that it's still holding up. Short term, the list that we have is a lot shorter. We have the CCI 14 and the stochastics, which seem to be extreme positive or negative all the time. That's a pretty bipolar indicator. The dollar was up and interest rates were also up. And if you notice on our charts, the 30 to the 5-year has switched back to being normal now. All of the other yield curves are still inverted, but we've seen this happen before. We've seen the 30 to the 5, which is not a real major spread that people watch, but it's gone back to being normal, stays that way for a little while, and then slips back into being inverted again. So not a huge deal, but I just wanted you to make aware of that. We're still positive at 72 with sentiment, and our trend is positive, but this is strange. On Friday, we saw the green line go up on a down day. On Monday, we had an up day, and we're seeing the green line going down. The ADX is even having a hard time figuring out what it wants to do right now, but the trend is weakening because we're dropping below the moving average, but we're still in a trending environment because we're coming down off of that 40 level. Because we had the up day, our bias is positive, and I'm keeping our momentum at mixed right now. There was not a lot of conviction behind the move. The economic reports that came out, we just had consumer credit, which came in at 17.9 billion, more than the 13 billion they had expected. And there's a lot of different reasons for this. People might be having to take on debt now just to handle their monthly obligations. Here's a chart showing how consumer credit has been going up, and I don't have the laser pointer on here. I just have to go with my regular pointer when I'm looking at things today, and I can't zoom either. I don't have any isabelnet.com blog charts. I just wanted to get this video posted today, so I'm not getting into a lot of extra things. So let's go into our charts. Here's the intraday chart where we did gap higher, but when we gapped, we opened right at the daily pivot. There's usually not a big difference between the unchanged level and the daily pivot. Well, that was the exception on Monday. We went up a little bit, came back down to the daily pivot, and then just ended up going higher, and we closed at the high right at the end of the day. Not really much changed all that much other than working off some of our short-term oversold indications. The intraday chart, where we were pretty much flat on Friday, and then when things opened Sunday afternoon or evening, we gapped higher, but then drifted a little bit lower. As the cash session opened, it ended up going higher, and we're pretty much flat as we go in the initial overnight session. Intraday, with the growth versus value, where you can see that the blue line really underperformed the red line. We were just barely positive with growth, where value did outperform. And then on a closing basis, growth was up, but a lot less than value. It also underperformed for the mid caps, and it was really down compared to the small caps. So when you do the buy low, sell high growth idea, not a lot of improvement really happened. Here's the growth to value ratio where we were below the unchanged line. We did tick up as the day went on, but we really gapped lower. Looking at sentiment, the Ulcer Index is starting to go up a little higher. As the market's getting a little more nervous, we're seeing some fear creeping back in. The VIX actually declined on the line chart and the bar chart because we had an up day. Looking at the VIX of the VIX, volatility has really dropped off right now as things were more calm. And then I'm showing this because we had gone extreme with the RSI 9 on the VIX, but now we're starting to come down and we're more neutral as far as movement is concerned. Looking at the equity put call ratio, it's continuing to go up on our 5-period simple moving average. Usually when this is going up, that means the market's going down. This is a warning sign and something we want to keep a close eye on. Here's a longer term look at that same chart. But longer term, we're still doing okay. The long 253 period simple moving average continues to decline. When this is declining, that tends to be positive for the market. The VIX to move ratio, which really spiked up on Friday, has now come back down. And then the skew index is starting to flash some signals again. We're coming up into this red area, meaning the market is expecting some kind of a big move. Now, some folks get real dogmatic and say, well, this means the market's going to go down, or this means the market's going to go up. If you look at other times when we had these readings after it finally spiked and started coming down, sometimes it kept going up. Sometimes it marked the bottom, other times it marked the top. So we have to look at other charts to get the context of what we think will happen. Looking at this fear gauge, it's starting to go back up just a little bit. And the other fear gauge, it's kind of hard to see, but it is turning back up slightly. Then the ratio between risk on and risk off continues to decline. It ticked up just a little bit on Monday. The advanced decline line studies were going back up based on price because we had a higher day, and we turned back up slightly based on volume. You can see at the top where this green bar, that's fairly positive. Also with volume, but there just didn't seem to be a lot of conviction in the move. We're rolling over with our 5-period moving average of the new highs minus the new lows. We're already declining with the 10-period. We did see more new highs than lows, but again, it's starting to decline overall and staying at a lower level. Then looking at the advanced decline ratio, it was able to cross back above zero. The blue line had crossed below the 0 point. Well, now it's back above, so that's slightly positive. Accumulation distribution, we're still under the moving average, but we are turning back up a bit. This kind of gave us a heads up before we saw this decline when we dropped below the moving average. And then a day or two after that was when we saw the markets having some trouble. If this goes back above the moving average, that could give us a little bit of a heads up that things are turning more positive. If we continue to stay below the moving average, then we'll probably end up staying more negative. And this tries to measure what is the smart money doing. Also, looking at the cumulative NYSE advanced decline line with the up day, it did advance. We're also going up slightly with our regular advanced decline line, and we're still above this upward sloping trend line. When we look at the common stock advanced decline line, ticked up a little bit, as well as with volume. So price and volume were both a little more positive, but we're still seeing this longer term negative divergence where price had been breaking out, but that was not confirmed by volume. All right, the advanced decline line studies, we saw a bit of an improvement across the board. Everything is above its moving average. The trend, we started to decline, even though we had an up day. On Friday, it ticked up on a down day. The trend is declining, but the green line is still on top. We want to see the ADX go back above the moving average to show that this trend is actually getting stronger. But for right now, it's still positive. And here's the shorter term chart where we're also turning down with the green line, but we're declining as well with the red line. But the overall trend is showing weakness. Volume is actually down to about average and dropping somewhat below. Our short-term charts on a daily the daily chart is showing that we're still below this pivot level. One positive thing would be, can we get back above that pivot point? And you can see where volume was quite below average on Monday. We're still below the 20-period double and triple exponential moving averages, and they are rolling over. That's more short-term negative. We're also coming back up to the exponential moving average. That's the blue line for the 20 period. That's somewhat positive, but most people use simple moving averages. We want to get back above the red line. Then looking at our moving average study, we turned back up with the 20, 50, and a little bit higher with the 200. The CCI 14 is still extreme positive, but it did show a bit of an advance. The stochastics turning back up in the short term after being extreme negative, still extreme negative in the intermediate term, and we're declining in the longer term and no longer extreme positive. The force index, after hitting the Keltner band down here, we're bouncing back up off of that a little bit, so that's no longer extreme. The intermediate term chart, the balance of power, we're below the dashed line, but ticked up slightly. That's still negative. The CMB composite gave us an extreme negative reading. That's no longer extreme as it bounced. The 50-period double and triple exponential moving average, we're starting to roll over. That's more negative. We're still below both of these moving averages. But when we look at our 50-period moving average, we're still above the simple and exponential moving averages. This could be the next line of support if we continue to fall. So we want to keep a close eye on that. That's currently at the 44.20 to 21 level, but this changes every day. Looking at our moving average tree, we're dropping a bit below the 20-period moving average. The 50 periods are still below current price. The go-no-go system is still neutral with the lighter colored blue bars. We're getting down to the lower end of our lowest low value and dropping below the midpoint. That's more negative. The TTM squeeze, still positive, but it is declining with the darker shade of blue bars. Another day or two of this, and we're actually going to drop below zero. The standard deviations, we're right back at the midpoint. How's that for balance? The ease of movement, we're declining and below zero, showing the path of least resistance remains down according to this chart. The Bollinger Bands, we're getting a little bit underneath the midpoint. The Arun is starting to show a decline as selling is dropping off and, as buying is dropping off and selling is picking up. We're still at the underside of our 20-period simple moving average of the open, high, low, close. This may now act as some kind of resistance, but when we were coming down in the uptrend, we want to see prices break back through above this. If the whole mini rainbow starts to roll over, that would be more negative. The S&P McClellan oscillator, after almost getting extreme negative, has bounced back up, but it's still below zero. So when we look at our summation index, we're declining based on price and volume. The NYSE McClellan oscillator ticked up as well, but it's still below zero. We're starting to see things roll over with the NYSE summation index based on price and volume. The Swenlin trading oscillator below zero, so that's negative based on price and volume, and they were pretty much flat. The PMO starting to turn a little bit more negative. We had a bit of a heads up based on price and volume. Sometimes this can lead us. The PMO study, we bounced up a little bit with the PMOs that are rising. We were flat with the buy signals. We're still continuing to decline with the PMOs that are above zero, and we're just coming off an extreme reading. The Elder Impulse system for the S&P is neutral. The parabolic, and this is kind of a big one, at least I think it is, the dots continue to be above. The slope is also turning more negative. The MACD is turning negative, and I can't zoom in on this, but you can hopefully see that all of our oscillators are now turning down. The Sean trend meter ticked up a bit. It had been extreme positive, but it wore that off. The BPI, again, two ways to look at this. We're still holding up, but we are declining after giving an extreme positive reading. So overall, this is negative. It'll turn more negative if we drop below 70. The NYSE bullish percent index is declining. The Chaikin money flow, this also gave us a bit of a heads up. This tries to measure the smart money. It was dropping and went negative before we saw real conviction with price, and it's still looking more negative. The Chaikin oscillator ticked up a bit, but it's still below zero. The money flow below 50 and declining. The vortex, and I made note of this at the end of the video, the red line is crossing above the green line. That's negative. Ultimate oscillator ticked up, but it's still below 50. The RSI also ticking up on the 9 period and the 14 period, but not really showing any strong positive conviction at this time. On balance volume did tick up. It's still above the moving average. Our 200 period simple moving average study did tick up after it had been declining, saw a bit of a tick up with our 50 period moving average. The Pring bottom fissure signal is now going away. Our Fibonacci and line studies were coming down below this shorter term trend line. We broke below that. If we continue to fall, we're still looking at about the 44.50 level for support, which is not all that far away from the 50 period moving averages. We're also coming into the new cycle. We started on August 1st and been having some trouble. Is this still going to continue throughout the rest of this 50 period cycle? Our different charts, the Heiken Ashi is looking more negative. The Kegi is negative, even though it's pointing up. The red line means it's negative. The Renko has redrawn again, and now it's looking more positive. The 3-line break is looking more negative. The indexes, we see the equal weight and the S&P performing about the same. The ratio isn't changing all that much right now. Dow theory, we saw a bit of a move up with the Dow, but we didn't see a move up with the transport, so that's a little bit negative. Utilities ticked up just a little bit after seeing some weakness. So when we look at our transports to S&P 500 ratio, we did decline slightly, but overall we continue to advance in a positive environment. We want to see that keep going up. Looking at the Dow to transports ratio, it did tick up just a little bit, but the transports have been outperforming the Dow, and that's more positive. Looking at our discretionary and staples equal weight study, at the bottom we ticked up with the ratio, and we continue to be in an overall uptrend, showing that discretionary, meaning growth, is outperforming staples, meaning value. But it didn't do so that much on Monday. The Dow was up over 1% and is still above this pivot point. That is positive. We're back to being positive with the diamonds. But when we look at the NASDAQ, we're still underneath this pivot point. However, we're still above this S1 level. And when we look at the 61.8% retracement level, we're still hanging in there as far as support. We're going to be watching that at about 13,874. But as I always say, please be reminded that I put these lines in here myself, so these numbers might not be exact. The new highs, new lows for the NASDAQ continue to show weakness, and we're dropping below zero with our raw score. We're also still above the August 2022 high. That's a more absolute number because I can use the computer to put an exact amount in there. So far, this is hanging in there, but we're still below this pivot level. We're right stuck in no man's land. The Elder Impulse system for the Qs is switched to neutral. We're still looking more negative with the NASDAQ 100 and the PPO, which is a momentum oscillator. The NASDAQ 100 BPI continues to decline after giving an extreme positive reading. The small caps were up on the day, a little over 0.5%, and are still above this pivot point. But we still are neutral with the Elder's Impulse system. The Russell is still below this longer term resistance. We went above it and then broke down below it. On the positive side, we're still working off of a recent golden cross. The RSI is right at about the 50 level, but on the negative side, the MACD continues to be going down. The small cap to S&P 500 ratio showing a little bit of improvement, but overall continues to decline. Looking at the small caps, and this is a little bit disappointing. The small cap growth to value, it's really trailing off, even though longer term it's still in an uptrend. The mid cap still above this pivot level, so support is holding. And we switch back to positive for the Elder Impulse system. But when you compare mid cap growth with value, we're seeing a real breakdown here, even though it's still in an overall uptrend. The FANG index coming down and just above its 50 period moving average. After going above and setting a new all-time high, now we're having a really hard time getting back to the previous all-time high. Growth is starting to underperform value, and value is starting to show some improvement when compared to growth. Home construction, though, still saw a bit of a bounce up and is in good shape when compared to 3 to 7 year bonds. Keeping an eye on the banks, still above the 200-day moving average. The financial sector generating a golden cross. We're still in a downtrend when we look at the financials to S&P, but we are showing some improvement. The regional banking ETF compared to the financial sector is showing some improvement, but still in a downtrend. And just as a side note, there's a couple of perma bears that I pay attention to from time to time, and they're just saying it's the end of time for the banks, that everything is going to fall apart. But yet on our charts, yeah, they're still negative, but we're seeing some improvement. And we've also been seeing some insider buying. So these folks have a real tendency to be wrong, but they're always negative on things. The world is just about going to end. It's always right around the corner, but they've been saying that for over 20 years. Eventually, if they say it long enough, they'll be right. Looking at bonds, where we were up slightly based on price, we were down slightly based on volume. We were down slightly based on, okay, let me go back and here's another take two. We were up slightly based on the yield. So interest rates were up. We were down slightly based on price. We're seeing a recent death cross here. The MACD is also negative and we're below 50 and declining with the RSI. So based on price, bonds are looking more negative. All right. How's that for take two? Looking at cash and then comparing it to the 3 to 7 year bond ETF, we're still tending to go up overall, and that is a bit concerning. We want to see this ratio going down. Here's the 3 to 7 year spread where it crossed back above zero and is trying to turn more normal. You can see over the last couple of years where it's been jockeying around quite a bit. So I'm not getting too excited about this. Looking at the equal weight S&P 500 index and then an inverted chart of the MOVE index, they're having a tendency to go in the same direction. This is a newer chart. I'm still trying to figure out what insight we can get from this. We're still above the 2007 level with the 3-month yield, and it's continuing to advance. Our longer term charts, we're still positive with the daily special K. We're coming right back up to the resistance line on the weekly S&P chart, as well as with the NASDAQ 100 chart. We're still keeping an eye on this. This is longer term negative. When we look at the ratio between the NASDAQ 100 and the Dow, we are coming back down after giving a pretty extreme reading. Now, we might have one good thrust left to the upside before things really turn bad, or we could always set a new precedent and break above this with the ratio. But historically, back in 2000 and then right at the end of 2021, we hit this high level and that spelled some real trouble for the market. So we just want to be aware of this. An update of our possible positive scenarios, not much of an improvement with the Qs to S&P. Discretionary's been hanging in there a little bit better. Large cap growth is underperforming large cap value. Not much of an improvement with the large caps, a decline with the mid caps, and we were flat with the small caps. The S&P to utilities ratio, this is positive. We're still seeing this ratio going up. And then when we look at the broad range of our 5-period moving average of the highs minus the lows, we're still just barely positive. This is starting to drop as well. And we've been hanging on to this as showing us good momentum. When we look at the 10-day average of the S&P highs minus the lows, we're starting to come back down now. If this really starts to pick up steam and drop, that'll turn more negative. Also, this is negative. We're dropping below zero based on price and volume with our 19-day exponential moving average of the advanced decline ratio. You can see where I have the red arrows. And then looking at our 50-period exponential moving average of the new highs minus the new lows, we're turning down a bit, but we're still above zero. Our indicator is starting to fall below the moving average. That's why we're seeing the red line turning down. Growth versus value, a little bit disappointing right now, where growth is underperforming, even though it's still in an uptrend. The staples came down just a little bit on Monday, but they have been declining overall. We're wondering, will this give support to the S&P? And then this kind of goes against what we're seeing in the charts right now, where when you look at August, it's the 3rd worst calendar month, according to Tom Bowley. Energy is not hot, and it had a good week last week. Tech is usually hot, and it had a bad week last week. In the early part of August, we tend to be up the 1st through the 5th. Now that we're getting more into the middle of the month, the 4th through the 10th, we tend to be down. Then we have a good spot from the 11th through the 17th, and then we tend to finish things off more negative at the end of the month. And basically what he's saying is, even though the summertime is pretty negative, this is when growth really starts to outperform value. We're just not seeing that yet. And then some industry groups that tend to be good in the month of August are computer software as well as computer hardware. So our outlook for Tuesday, we will get a lot of earnings reports. By the end of this week, most of the S&P 500 companies, about 80+%, will be finished. There are no more scheduled Fed speeches for the month of August. I looked at their calendar. There was nothing on there. Then I went back over the weekend and there was one for Monday. So that's already come and gone. But as good as I can tell, there's no more speeches coming. The technicals are negative, and right now it looks like we're working off this short-term oversold condition, but we're still turning negative in the bigger picture. But at the same time, support continues to hold. We will get the the NFIB Small Business Optimism Index, the Trade Balance Report, and wholesale inventories. We're keeping an eye on the geopolitical events. Right now, it's about inflation, interest rates, and earnings for the most part. Here's the updated economic calendar for the week. Notice on Thursday, we will get CPI, and on Friday, we'll get PPI. For the Stock Traders Almanac statistics for August 8th, we're neutral to positive with the Dow and S&P. We're neutral to negative with the NASDAQ. Here's the updated calendar of what it's looking like for the NASDAQ. We're wondering, are we starting to come out of this weaker period right now? Sometimes we get a little bit of bounce from this, and we did see that on Monday. We want to see if that can continue. We will be on the 6th trading day of the month, where sometimes we tend to be lower in pre-election years with the dashed line. Going back to 1950, in pre-election years, we're up 50% and down 50%. So our scenarios, we're still going with the down one, but we're really keeping an eye on the support level. If we start to break and go lower, that could turn things a lot more negative. As long as we're hanging out above that, we still have a glimmer of hope to the positive side. We're not going with the up scenario. Our charts just don't support that. Even though the ADX is declining, it's weakening, but we're still in a trending environment. So we're not going with the sideways trend. The warning signs, we did see a convergence of these short-term bearish signals. We're wondering, are they finished now? Are they going to come back and try to do it again? But we did see that weakness played out. Our longer-term trend signals may be signaling a top. Those are the weekly charts for the S&P and NASDAQ. We're right on that level right now, so we don't know. Seasonally and historically, we are in a weak time of the year and also a weak time of the month. The oscillators for the S&P are negative, and we're keeping an eye on the NASDAQ 100 oscillator, which continues to be negative. The VIX is still showing a lot of complacency. Even though it did tick up on Friday, it ticked down again on Monday. The cumulative new highs, new lows on the NASDAQ are still showing weakness. We're still above the level that we were at on the 3-month yield going back to 2007, and that happened right before things turned really bad. So we're wondering if that turns and starts to come down, is that going to give us a warning sign? S&P 500 growth is weakening, but it's still in an uptrend. The weekly pivot, that was a week and a half ago now. We hit that high level, and that's when we started this decline that we've been in lately. The parabolic SAR is negative. The vortex is also turned negative. The Pring bottom fissure has now gone away, and we're still dealing with earnings season. On the positive side, our longer-term positive seasonality and setups still are in the background, and I went through those on the weekly chart. I went through those on the weekly video. The long-term special K chart is still positive. The weekly chart is still negative. Our longer-term equity put call ratio is still positive. We're still above the downtrend channel upper line on that one trend that I show sometimes. We're still in a risk-on posture, even though it's not showing a lot of conviction right now. We're still holding its support and wondering if that will continue. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they're above the resistance when they broke out, but they're still below these daily pivot levels. The Staples to S&P 500 ratio is declining. The Russell and small cap, as well as the mid caps, generated recent golden crosses. Small and mid cap growth continues to be positive, but we're seeing a bit of a breakdown now in the mid cap growth. And then the financial sector has generated a golden cross. So our conclusion, we're negative and we're just working off this short-term oversold condition. And we still remain negative anyway. But support is still holding, and we're just asking, will this support keep holding? In the short term, we're negative and just working off being oversold. Intermediate term, we're just more plain vanilla negative. We're still positive in the long term because we're above the 200-day simple moving average. Thank you. And I apologize for all my mistakes and everything and different quality. I don't know, maybe some of you might even like this better. I hope you have a really good day, and I will talk to you in the next video. If I can get this to stop. Oh, here's some notes here if you're still watching this. I'm trying to get this thing to come up to stop the recording.